We're going to go over how high-income earners are using Colorado Vacation Home to legally reduce their tax bill to zero. We actually ran this webinar at the end of last year and had clients scrambling to buy something in time to capture the tax benefits. So this year, we're getting ahead of it while there's still plenty of time and inventory to be strategic about it. So I'm excited to get into it. All right, quick intro on me. I'm Miriam. I'm a Colorado-based investment specialized real estate agent serving all of Colorado, and I am also an Airbnb investor here myself. I am part of a team that sold over $200 million in primarily Airbnb properties last year, and I personally invest using the same strategies that I teach. My partner and I are using this specific tax strategy to buy another property every single year here in Colorado. I help clients find, buy, and launch high-performing Airbnb properties, and I make sure that they're set up to capture the full income and tax benefits.
Awesome. Hey, everyone. My name is Steven Chau. I'm the founder and principal of Citadel CPA Group. We're a firm based out of Centennial, Colorado. Been around for a little over a decade now. And myself specifically, what we specialize in, the firm as general, I should say, we specialize in real estate transactions and strategies and advisory services. So, a lot of the things that we talk about with our clients are related to short-term rentals, midterms, long-terms, doing 1031s and real estate development. And myself, I'm also a real estate investor. And so a lot of the advice that I give is not just theoretical, but it's practical based on real life experience, not just through owning properties, but also, working through audits with the IRS on these matters too. Something to note real quick before we proceed to the next slide here. I'm not sure if the chat is working. If it's not, don't worry about it. We do have questions that were submitted earlier by other clients of ours and viewers that weren't able to attend. And so we'll be doing a little Q&A session at the end to go through some of these questions.
Awesome. Whoops. All right, so before Steven gets into all of the technical details, I'm going to walk through the basics of what this strategy looks like and show some real client examples. So the short-term rental tax loophole. So really quick, for anyone who isn't familiar, short-term rentals are the technical name for Airbnbs. So I'll be using those terms interchangeably throughout the presentation. So what is the short-term rental tax loophole? Basically, when you purchase an Airbnb, the IRS allows you to take 30 to 45% of the property's value as a loss against your earned income in the year that you buy it. So here's an example with really easy numbers to show you what that looks like. So let's say you buy a property for $1,250,000. Land can't be depreciated, so we'll take out 20% for land. That leaves you with the property's value at $1 million. You can take 30 to 45% of that property's value as a loss against your earned income. So 30 to 45% of $1 million is $300,000 to $450,000. That is how much you get to write off from your taxes. So if you made $400,000 that year, it would eliminate your tax bill. So at a 32% tax bracket, that would be over $100,000 back in your pocket. Or if you're a business owner, just $100,000 you wouldn't have to pay in taxes. All right, and then here's a real example of an actual property. This property was purchased for $915,000. Then they hired a company to do a cost segregation study, which identified about $277,000 in assets eligible for bonus depreciation. That created a $277,000 deduction in year one, which translated to over $85,000 back in their pocket at a 32% tax bracket. All right, so what is a cost segregation study? So once you purchase the property, the way you unlock these large tax write-offs that I'm talking about is by getting a cost segregation study. So I have a great company that I recommend that handles this for our clients, and that runs about $2,000. Super worth it, though. You're getting so much more back in those benefits. The process is pretty straightforward. They come to the property, document everything inside it, and break it down for tax purposes. So the concept is basically even though the property as a whole is going up in value, obviously because it's real estate, the IRS assumes that the components inside it wear out over time. So things like flooring, cabinets, appliances, lighting, furniture, things like that. And because of 100% bonus depreciation, they let you write all of that off up front in year one instead of waiting for each of those to be written off over the years. And what you're looking at right now is a screenshot from a real cost segregation study. And if you book a meeting with me after this, I'm happy to walk you through a full report a lot more thoroughly. But this is just showing an example of those different assets that they assign a value to. All right, now I'm going to get into some case studies. So here are a few real client case studies that will show the full picture of what this strategy could actually look like for you. So this first client wanted a home near Breckenridge. So we found one in Blue River, which is about 7 minutes away from Breckenridge and just super short-term rental friendly. And this client's goal was a mix of tax savings, long-term appreciation, personal use. They wanted it to be by a ski mountain. And they wanted the Airbnb income to at least cover their mortgage and expenses. Cash flow would be a plus. Purchase price was $1,650,000. The annual revenue ended up being $168,000, which did fully cover the mortgage and all expenses, and it even gave them some cash flow. And then at 6% annual appreciation, it will be gaining $99,000 in equity every year. And then the big tax savings are $160,000 at a 32% tax bracket. All right. This next example was purchased primarily for tax savings. They had a lot of taxes to write off, but they also wanted a ski home for personal use, and the appreciation is really great in Keystone as well. So they purchased this home for $3.15 million. It hasn't been active for a full year yet, but it actually had a really strong winter despite us not having a lot of snow here. And so now the annual revenue is projected at $330,000, which actually should give them a little bit of cash flow, which isn't usually a thing at this price point. So that's pretty awesome. At 6% appreciation, this property gains $189,000 in equity every year. And at a 37% tax bracket, this unlocks a tax refund of over $370,000 in year one. All right, and how I underwrite an Airbnb investment. So before any client ever buys a property, I fully underwrite it so you know exactly what to expect. I do this before we see a lot of properties too. I will underwrite anything that you want. I make so many of these. But this is just a screenshot of part of a pro forma that I would make. And on these pro formas, I break down projected revenue, all expenses, potential cash flow, tax benefits, and long-term appreciation. I also map out what this investment will look like over time, including your year 1, year 5, and year 10 financial outcomes. This way, you're making a very clear data-backed decision before you ever go under contract. All right, so one of the biggest misconceptions is that you need 20% down. You absolutely don't. There are loan options as low as 10% and 15% down, as well as a DSCR loan that doesn't involve your DTI. So lots of options that we can obviously talk about in a meeting after this. And these are just the basics of the strategy from the real estate side. So I will hand it over to Steven now to break down the tax side.
Awesome. Thanks, Miriam. So just real quick, everyone, full disclaimer here. Please don't take any of this as tax advice specifically for your situation. What we're going to be talking about here and what I'm going to be walking through is going to be more from a high level perspective. Everyone's landscape is unique, and so I would highly recommend seeking a CPA or tax attorney to discuss your specific situation. All right, so with that out of the way, let's go over what the short-term rental tax strategy is from a tax perspective. And to start off, we have the 3 components to break it down simply here for you to make this work. And you need all 3, because if you're missing any one of these, it's not going to work. First, you need to have a short-term rental property, all right? And it has to be a short-term rental. We'll go into a little more detail as far as what qualifies as a short-term rental, because not every property is going to qualify. Second, you need to meet one of the material participation tests. There are 7 that are prescribed by the IRS. We'll go through the 3 most common ones that our clients end up meeting. And lastly, what Miriam touched on is the cost segregation and the bonus depreciation. As many of you are probably aware, we had the change in legislation in July through the One Big Beautiful Bill last year that restored bonus depreciation back to 100%. And so what that means is if you purchase a property and it's after the qualifying date and you place in a service and it meets the other 2 criteria here, then you're going to be able to, as Miriam alluded to earlier, write off a pretty significant portion of the property that you otherwise would have to depreciate over, if it's a short-term rental, 39 years. So let's go into what a short-term rental is. Miriam, can you go to the next slide, please? All right, so and what is a short-term rental? The IRS actually doesn't explicitly define what is a short-term rental. It defines it by telling you what it is, what doesn't qualify as a rental. And the exception is under this regulation here that states if the average period of use or the average number of days stayed at the property is 7 days or less, then that means it qualifies as a short-term rental from a tax perspective. A question that we often get from clients is, well, how many days does it do, or how many stays do I need to have in order to meet this qualification here? And this is going to be extremely important as if you're looking at purchasing a property towards the end of the year. And so the answer to that is to get an average mathematically, you need at least 2 stays, right? And it's okay if one stay is longer than 7 days, as long as the average of all your stays is 7 days or less, then it's going to qualify as a short-term rental. And if you're listing on your popular platforms like Airbnb or VRBO, they have a really good system in place that's going to track the stays, and it's going to be able to generate a report that you're going to be able to provide to your CPA at the end of the year to document that. All right, so we covered the short-term rental exception here under the regulation. Let's go to the next slide, and let's talk about material participation. So as I mentioned earlier, material participation, these tests, there are 7 different tests that the IRS prescribes. Now, the 3 most common ones are the ones listed here that we see our clients meet. First one is going to be the client putting in at least 500 hours. And if you put in 500 hours, doesn't matter if you have a property manager, doesn't matter if you have a cleaner, you're gonna meet this test, okay? Second test is going to be 100 hours, at least 100 hours, and more than anyone else. And so this is going to be the test where you're going to want to make sure that you are documenting your contractors' hours. So the cleaners, the property managers, if you do, and you really want to make sure that you're watching the hours that they're putting in on your property to ensure that they're not crossing over the hours that you or if you're married, if you have a spouse, a partner, they're not putting in more hours than you. Third one is going to be substantially all the work. This one is going to be the one where personally I'm not the biggest fan of, but if you are able to document it well and prove that you don't have anyone working on the property, so effectively you're doing all the work, and I'm talking about you're taking out the trash, you're turning over the property, changing the linens, all of that, and you don't have anyone else involved, then you're going to qualify for this. There are some special nuances with each of these, and this is, like they say, the devil's in the detail here. There are provisions within each of these that you need to watch out for, and that's what we specialize in. That's what we're here to advise on, right? So I'll give you an example with that last rule, substantially all the work, right? Well, there's a provision in the rule, in the regulation that states if this was a short-term rental previously, prior to you acquiring it, the non-owner's work or their hours will also count. So you need to be extremely careful with that because it also includes non-owners, meaning if they sell it to you, they're no longer an owner. So all the work that they put in is going to count, and it's no longer going to qualify. So that's just an example of some of the pitfalls that we help work through with our clients. Couple of things here to know with these hours. Married couples can combine their hours. So some of you may be familiar with real estate professional status and the requirements for that. This material participation is completely separate from your real estate professional status test. The hours that you put in here, you can actually combine it. If you're married, if you have a spousal partner and your filing is married filing joint, you can actually combine your hours. And if you're able to meet the material participation test, then what you've effectively done is now you've reclassified the income from passive to non-passive. And that's what actually allows for you to write off the losses, if there are any, against your active income, because that property, by qualifying as a short-term rental, we crossed that first prong, or we met that first prong, right? And so now that property is no longer considered a rental property, which allows you to materially participate, which if you do, now it's non-passive. But if you only did these two things and you didn't do a cost segregation study, you're really shorting yourself, because you just put in all this work, but if you're just depreciating over 39 years, you're really not getting that much of a write-off. So that's where the third piece comes in, where you have to do the cost segregation study. But before we get into the cost seg, let's just go through from the material participation, high level, what kind of activities count for material participation and what activities do not. Miriam, can you go to the next slide, please? All right, so I'm not going to go through every single one of these here, but I listed some general activities that will qualify for material participation. And generally speaking, right, it's going to be any activities where you're actively participating and managing in the day-to-day operations of the activity, right? So if you think about communicating with the tenants, or if you are heading to the property and putting in time to turn it over or make small repairs, buying supplies, things like that, everything listed here are going to qualify as hours for material participation. The next slide that we're going to be going through here is going to go over hours that don't count. So again, this is another one of those pitfalls, right? Where people think, hey, if every hour that I incur for this property is going to qualify. Excuse me here, guys, real quick. I'm going to pull down this blind. It's like right in my face. Okay. All right. Sorry about that. So as I was saying, the hours that do not qualify for material participation are going to be investor hours. And those are going to be the ones listed here, right? So if you are reviewing the financials, the pro forma for the property and trying to understand the economics of the transaction, those hours don't count, right? If you're putting together compilations of financials, summaries, things like that, if you're just monitoring the operations in a non-managerial capacity, then those hours are not going to count. And then also real estate education, so going to like seminars and also being on call for certain hours, those are not going to count, right? These are hours that are specifically called out in court cases, previous court cases, as well as regulation, and also just in our experience working through short-term rental audits with clients, right? We had a client, I'll give you an example. They were audited by the IRS, and they attempted to go to achieve this short-term rental write-off on their own, and they weren't aware of all the nuances of the rules, and so they were including hours where they met a plumber or they met an HVAC person on their property, and they basically wrote down 4 hours that they were there performing HVAC work, when really they spent maybe 15 minutes to let them in and see them out and maybe talk with them about it. But really, majority of those hours were completed by the HVAC and the plumbers. And so on-call hours do not work. It has to be hours or time that you are actually putting into the property yourself. Okay. All right. So now wrapping it all up together, as I mentioned, if you met the first two, that alone is not going to be sufficient. What really ties it all together and what makes this strategy really work is by doing the cost segregation and getting the bonus depreciation, especially after we had the legislation restore it back to 100% at the federal level. All right. And so as Miriam mentioned earlier, what this is when you do a cost segregation study is you're accelerating, you're carving out components of the property, and it's not done by us as a CPA firm. This is done by an engineering firm. There are a handful of engineering firms out there that specialize in this space, and they come in, they have a database of information that they can use to carve out portions of your property, items that qualify under tax rules. Okay, this is where the tax piece comes back in. Is the IRS has regulations that tell you what assets qualify under 5-year assets, 7-year assets, and 15-year assets. Okay, and so what that means is if these properties, if these assets within the home qualify and they fall into one of these buckets, the segregation firm will allocate it into the various buckets here, the corresponding buckets. And as a result, those properties will qualify for bonus depreciation. Versus if you didn't do this, now all of your entire purchase price, the depreciable basis, is going to be depreciated and recovered over 39 years. And if you're, let's just say, I'll give you a high level example here. Let's just say your depreciable basis is 800,000, and we took 800,000 divided by 39 years. That's a $20,000 deduction per year. Versus if you took 800,000 times 35%, that's a $280,000 deduction. So you're going from 20,000 to 280,000 by just going through this cost segregation study here. But you still need the other two components. So please don't forget about that, right? It needs to be a short-term rental, and you still need to materially participate. Otherwise, it's a passive property, it's passive income or passive losses, and you would have just spent a ton of money to do this segregation study, and you won't be able to take any tax benefits from it. All right.
Awesome.
That's all I have for me.
Awesome. Thanks, Steven. So now that you understand the strategy, what most people want to know next is, how do I actually do this? So just a little bit about when you work with me as a realtor. I guide you through every single step from search to launch of your Airbnb. I underwrite every property that you're interested in, help you identify the right market, provide a fully vetted vendor list with every Airbnb contact you could possibly need. I help you set up automation and more. Pretty much anything that you could possibly need, I will help you out with. I basically provide the guidance that many investment coaching services charge thousands for, but it's built into my realtor service at no fee, besides the cost of the home that you're buying, of course. So if you are interested in doing this, the next step is to book a Zoom call with us. For my calls, we will walk through your numbers, your goals, and what this could actually look like for you, so you can move forward with a very crystal clear plan. Or even if you just have more questions, I'm happy to talk. So feel free to throw some time on my calendar.
Likewise for me, I have a QR code here. It'll lead you to an intake form. So if you're interested in learning more about the short-term rental strategy here, or if you have rental properties in general, right? That's another question that we often get, and I believe it's one of the questions that we got from one of the viewers here. We'll talk through that. But if you guys have any questions at all related to your taxes, if you're interested in tax strategies in general, please feel free to complete the intake form, and we'll have someone reach out and schedule a meeting. And the discovery meeting is complimentary. Okay. So with that said, let's jump into some questions that have been submitted. First question, I believe this one, Miriam, is actually going to be for you. So this is a question from Lauren. Which market or area should I be looking for a short-term rental?
Yeah, awesome. So that is exactly what I help you figure out. So every market in Colorado has different short-term rental regulations, different occupancy rates, different price points, and different guest profiles. I've already done this research, so I know which markets are strong right now, and which ones have legislation that could hurt you or help you. So you don't have to figure that out on your own, but I will help you based on what your goals are. Some people prefer mountain areas, some people prefer metro areas. I serve all of Colorado, so that's something that we can really narrow in on our call.
Great. Second question's from Allie. How much of my time does it take to self-manage the STR?
Yeah, I love this question because self-managing is so much easier than people expect, truly. And I help you set up automation for nearly everything, cleaning, messaging, pricing, and more. So it ends up taking about an hour a week total. You really just need to worry about calling a contractor if something comes up, and I provide the vendor list to make that easy. But to put it in perspective, my partner and I manage 5 properties on top of our full-time jobs. Also, about 60% of our clients are out of state and self-manage to get the tax benefits. You also only need to self-manage in year 1, so you can always hire a property manager after that. But a lot of people plan to hire one and then realize it is not as hard as they anticipated.
Great. Question from Michael. This one's for me. I bought a property for $600,000 last year. At what point does the cost segregation actually make sense? Is that too small? And so that's a great question, Michael. I will say even at $600,000, it's there's savings to be had, right? The way I kind of look at it is not so much from a how much, is that too small, but if you guys want to do quick math on your own, you can take whatever the purchase price is. This is what I do. I'll give you my tip here is I'll take the purchase price, I'll multiply it by 80%, right? Taking 20% out for land. And then we're left with 80%. So that puts it at 480. And at 480,000, if you took, let's just be conservative, let's take 30%. If you took 30% of that, that means you're potentially going to be able to do a cost segregation study and write off, assuming you meet material participation, $144,000, right? So that's still a very meaningful deduction for everyone here. Versus if you did 480 divided by 39 years, that's a $12,000 write-off. And so in my mind, that's a no-brainer, right? That's not too small of a property. Even if, I've worked with clients that purchase properties for $350,000, $400,000, and still were able to get meaningful deductions on their tax returns. One thing you should be careful of, though, for those of you that are looking, is working with your realtor, your broker, to really understand the land to building breakout. Because what we've seen is in certain areas, the land is extremely valuable. And so there will be a higher land allocation. And, the acceptable methods from an IRS perspective is either going to be a third-party appraiser or the county assessor. And so if there's a high land to building allocation, then your depreciable basis of what you can write off is going to be lessened as a result of that. All right, I have another question from Holly here. She asked, if I do a cost segregation and take the bonus depreciation, what happens if I sell the home in like 2 to 3 years? That's a great question, Holly. This is one that we get often. So from a tax perspective, the cost segregation, again, what you're doing is you're accelerating the depreciation, right? Instead of taking over 39 years, you're accelerating all of it to take it in the year that you incurred and place it in service. And so there's this concept called depreciation recapture when you sell the property. So if you were to sell the property 2 or 3 years down the road, that depreciation, the bonus depreciation that you took in year 1, you have to recapture all of that. And you recapture it, that's considered a Section 1245 property. You recapture 1245 assets at ordinary income tax rates. Effectively, the IRS says, well, we gave you the benefit of that deduction in year 1. So when you sell it, the first portion of the gains up to the depreciation that you took has to be recaptured, and you have to pay ordinary income tax on that. There are ways to be strategic around this, though, and again, this is where we specialize in. We can help our clients walk through the scenarios of doing a 1031, a lazy 1031, or maybe we look at the option of this does make sense for you. Maybe this year is that you're purchasing this property, you're in a very, very high income tax bracket. And then in the year that you sell it, you're in a lower tax bracket. So you're effectively able to arbitrage the tax rates between the years, if that is your goal. Um, Miriam, here's a question for you from Tim. How do I estimate how much income a property might bring in as an Airbnb?
Yeah, so that's what I help with. I underwrite every property before we make an offer using that performa that I showed earlier in the presentation. And I pull real AirDNA market data. AirDNA is a platform that scrapes all of the revenue from every Airbnb property all over the world. So it gives me real numbers to work with, but I use those numbers and I model out the revenue, expenses, cash flow, and tax savings to show you the full picture. And if the numbers don't work, I'll tell you.
Awesome. Another one from Courtney. Is it better to buy a condo, single family home, or some other type of property for an Airbnb?
Yeah. So in most cases, single family homes outperform condos for short term rental investing every time for a few reasons. Condos often have HOAs that restrict or prohibit short term rentals entirely. They also tend to have lower guest capacity and they generate less revenue. Single family homes just give you more flexibility, higher occupancy potential, and stronger appreciation. Absolutely.
Awesome. All right, last question I have here comes from Anne, and her question is, can I do a cost seg on a property I bought a few years ago, or is it only available for new purchases? That's a great question, Anne. And the answer is you absolutely can do a cost segregation on a property you purchased a few years ago. This is a question we often get, right? And there's a misconception where you can only do it if you kind of missed out on the opportunity and there's nothing to do about it. That's not true. If you purchased a property a few years ago, you placed it in a service, but you haven't done a cost seg, you still can do a cost segregation study. If it's been more than 2 years, you've effectively established an accounting method from a tax perspective. And so what that means is now you have an additional component where we have to file a 3115 to ask for or to request for a change in accounting method. Effectively, all that is doing is you're telling the IRS, hey, I'm doing this cost segregation study. I've been depreciating this property over 39 years or 27 and a half years. And I'm now requesting to change the method of accounting to carve out this portion and take it as a 481A adjustment on your current year returns. All right. So those are all the questions that we have so far. And again, this presentation with Miriam and myself here, we know we covered a lot, and it's meant to be more high level to help people understand the mechanics, the foundation for a short-term rental strategy. There's a lot more that goes into this, from purchasing the home and knowing what to look for, and what kind of amenities are going to be your best bang for your buck, to executing it from a tax savings perspective and understanding, what are the pitfalls here, right? And so this sounds a little biased, but I highly recommend working with professionals from the very get-go. Don't complete the transactions and then reach out to a CPA or a tax attorney. Work with us from the very beginning. Those are going to be the best case scenarios where you have the most success. And that's what we've seen with our clients as well, too. Miriam, do you have any closing comments or thoughts?
No, I think you covered it all. But yeah, like he said, if there are any additional questions, we are happy to help. So definitely throw some time on our calendars. Feel free to call or text me anytime. And I look forward to speaking more about this.
All right. Thanks, everyone. Appreciate your time here today. And hopefully we get a chance to have a call together. Bye-bye now.
Awesome. Bye, guys.